This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Manns, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey guys, welcome to this week's podcast. I'm Jason, and I'm here with my partner, Kyle Manns. And Kyle, what are we going to be talking about this week?
So this week we are continuing our book review of Nelson Nash's Becoming Your Own Banker. The section we're covering this week is creating your own banking system through dividend-paying life insurance. This section is located on pages 21 through 25, and we might break this down into two parts because there is a lot to cover here.
There's a lot to cover here. I think the first thing that I want to start out talking about is the difference between life insurance and all other types of insurance, like homeowners insurance and vehicle insurance. Is that okay, Kyle?
Yeah, go ahead.
Okay. So the first thing I want to say is when you pay premium to a life insurance policy, specifically permanent whole life insurance, there's a cash value component that goes along with that type of policy. With a homeowner's insurance policy, when you pay premium, you have coverage, insurance coverage, but there is no cash value associated with the policy. Okay, so there is nothing for you to leverage in those types of policies. That's the first thing that makes life insurance different from homeowner's insurance or vehicle insurance. The second thing is, when you purchase life insurance, you're insuring for something that you know is going to happen. When you purchase homeowner's insurance, you're insuring for something that may happen. You know, there may be wind damage to your house or vandalism or something like that. Those are all things that could happen, but are somewhat unlikely to happen. So those are the two biggest distinguishing factors between life insurance and all other types of insurance. It's also why Kyle and I believe that you cannot own too much life insurance in your life.
Yeah, I think that's a great overview there.
Okay. So where do you want to get started, Kyle? Let's jump into Nelson's book now.
Yeah. So this week we're talking about what goes into creating your bank with the life insurance company here. And to start off, Nelson talks about, or he has the definition of banking. Like what is banking? In today's terms, banking, the business of banking is devoted to taking money on deposit and loaning money and credit.
Yeah, and I like to tell people, all banking is at a high level is borrowing, repaying, depositing, and withdrawing. You need to be able to perform those four functions to perform banking.
Yeah. And the very first principle that we need to understand is that you finance everything that you buy. You either pay interest to somebody or you give up interest that you could have earned.
Nelson says that everybody gives lip service to this even though they understand the concept. It's like thinking that the law of gravity applies to everybody else but me.
Mm-hmm. Yeah, yeah.
It's kind of funny, but if you look at what a dollar could do for you today, or if you put that dollar into a life insurance policy today and look out 20 years, 30 years, 40 years versus paying cash, you're starting to see that reality that, whoa, there's a lot of money that I don't even see that's leaving my personal economy when I pay cash.
Yeah, and a lot of people say that taxes are your number one expense, but I think opportunity cost might rival taxes as your number one expense, but we just don't see it like we do with taxes.
You don't feel the pain because it's not a physical thing like interest expense that you pay to the traditional bank in town or a finance company.
Yeah.
It's something that you don't see, but it's still happening to you. And it's why a lot of people can't get ahead financially.
Yeah. And a lot of people aren't even aware of what opportunity cost is. I don't know how many years ago, but I wasn't aware of it. In this sense. So
I agree. It's something that isn't ever talked about in traditional finance.
No, absolutely not.
And Nelson goes on to mention an article that appeared in Fortune magazine that said that corporations were not applying this same concept in their business. They weren't accounting for the cost of capital, that they need to earn more than what their capital costs.
Yeah.
And basically all that boils down to is they weren't looking at the opportunity cost of putting those dollars somewhere else and making them work for them.
Yeah, they were paying interest to banks and other third-party lenders, but not seeing that their own money or capital, equity, whatever you want to call it, deserved to be paid interest.
Yeah, and they mentioned that was part of dark muddles of accounting, and maybe he's referring to some other shady practices that stock owned corporations or publicly traded corporations do, I guess, but we won't dive into that, I guess. Really, but
yeah. So economic value add, the gist of it is that you should be earning more than what your cost of capital is.
And to reaffirm that point, what I tell clients that I work with is, hey, we can look at this policy and we know what our cost of capital is when we borrow from it. If it doesn't make sense and I'm speaking about investing, if it doesn't make sense to where you're going to earn more than what this policy is producing, why even take the money out of the policy where it's growing safely, guaranteed growth? It's a good indicator for where you need to be outside of the policy.
Yeah. And Nelson said that EVA's basic premise is if you know what's really happening, you'll know what to do.
He couldn't have said that any better.
Yeah.
Once you understand what's happening when you're financing things, when you're accounting for opportunity cost, you'll know exactly what to do with your IBC policy.
Yeah. Yep. So next we're talking about creating the product. And Nelson, he uses this example of automobiles here. And he talks about how you can have the same two automobiles roll off the assembly line. Two different people own them. One might last 50,000 miles before it's wore out, and the other might last 300,000 before it's wore out. So we're kind of getting back to the deal of it's the owner of the product, of the automobile, that has more to do with how it works than the automobile or the product itself.
It's the owner's responsibility for how this product is going to perform in their life. It's not the life insurance company that we pick, so to speak.
Yeah, so like maybe somebody had a policy written up for them for somebody that was not designed for infinite banking at all. And that gets the rep of being horrible, high commission based policy compared to somebody getting a policy wrote with an IBC practitioner who wrote it that's optimized for the IBC concept.
And we are not saying that you can use some other type of product. It needs to be whole life.
Yes.
But just comparing whole life, it's the owner's responsibility to take care of his policy. And when you take loans out of your policy, this is what we're specifically referring to, playing honest banker with yourself and paying interest back to the policy, okay? With great freedom comes great responsibility. While you don't have to pay these loans back on a scheduled basis, for the plan to be successful, you want to do that over time.
Yeah.
So
the actuaries are really the engineers of the policies, and then they send their info to the rate makers to determine what the expenses are and what needs to be charged for coverage. And then it gets turned over to the lawyers who create the binding contract.
Right. And so those people have all put this together, goes out to a sales force. You and me are a part of that sales force, and we're meeting with clients. And we specifically are talking about IBC and creating IBC policies and how to put those in force. And what we specifically emphasize is that you are the owner of this policy. And if you want to borrow from this policy, you're first in line to be able to borrow the capital from the company. Okay, I think I misspoke there saying borrow from the policy. You're collateralizing the cash value in your policy and taking a loan from the insurance company.
And you are the owner of the contract. The company is not the owner of the contract.
Exactly. Well said. Now, what are the other places? Okay, if the owner doesn't want to use the money, what are the other places the insurance company can invest the money?
Well, the insurance company must put the premiums to work because they have an obligation to pay the death claim. So they'll put them into conservative assets bonds, treasuries, and other things in that nature. They'll buy businesses and stuff like that. The most speculative forms of investing that they do is real estate, but they, for the most part, do not participate in the stock market very much at all.
Right. A very low percentage of their portfolio is in the stock market.
Mm-hmm.
And that's because they have promised to pay claims in the future and they can't take risks like that.
Yeah. Yep. And the owner outranks every potential borrower, and this results in absolute control. So the company is really, like, its investments are really controlled by the policyholders because all the policyholders are first in line to use the money.
Yeah, Nelson says that the owners control the investment function of the company. And what he's really getting down to there is if every policy owner wanted to borrow the capital from the insurance company, then they would in effect be the ones doing all the investing for the insurance company. The insurance company wouldn't be putting money into bonds and treasuries, real estate, business, things like that. But of course, not everybody uses their policies in the way that we're teaching people to perform the infinite banking concept with them.
Yeah, most companies have a pretty small percentage of policy loans.
Right. I think it would be good to mention too that policy loans are the safest place that a life insurance company can lend money to. Can you explain why that is, Kyle?
Well, it's collateralized by the death benefit. So if the policyholder has a bunch of policy loans out and then dies, they're just going to subtract his loan balance from his death benefit that's going to be paid out.
Right. So think about it this way. When you take a mortgage out on a real estate property, you're depending on the mortgage owner to pay down his mortgage, okay?
Mm-hmm.
But the collateral assignment is based on what your house is worth. Now, the third party, whether that's a bank or finance company, isn't controlling the value of that collateral in that scenario. But with life insurance, the company is the one guaranteeing your death benefit. So they're controlling the collateral in this situation. That's why it's perfectly collateralized. They control the value of the collateral. There is no other financial vehicle where it works like this. And that's why IBC is so safe to do and implement in your life.
Yeah, so that's how the company makes income. So here's how some of the expenses are handled. So like death claims and hired help expenses. I mean, this is a life insurance company. They are paying death claims. So that is going to be expense when policy owners die. And there has to be people to run all the actuaries, the home office people. All those expenses are prorated and divided up against all the policy owners.
Right. Every policy owner is some of the premium that they pay is going to pay the hired help at the insurance company.
Mm-hmm.
Now, in the grand scheme of things, that's a small percentage of how much money that these companies are working with, but it's still expenses that come along with owning a life insurance policy.
Yeah, and with the mutual company, I mean, that one of the benefits of that is it is doing its business in favor of the policy owners, because the policy owners are the owners of the company. And what do businesses do? They do what's best for their owners. So that's why one of the reasons why we use mutual insurance companies.
Right. And so let's walk through Nelson's example now of he combines everything now. He's talking about the actuaries figured up that it would cost $1 to provide this plan of insurance to the customers or the clients. And the actuaries caution the rate makers. We think that that's what this is going to cost is $1, but our assumptions aren't set in concrete, right? So we should collect $1.10 to make sure that we can cover the guarantees inside of this policy, right?
Mm-hmm.
Okay, so we go through the year. Now the company can see its death claims, its operating expenses, and it can see its investment performance. Now they see that it only cost 80 cents to provide the guarantees to the client. What happens now? What needs to be figured now, Kyle?
So we have a 30 cents surplus from what they charged. And so what they'll do here is they'll keep some of it as a contingency fund for horrible times down, just preparing for bad times.
And it goes into what's called the statutory surplus of the insurance company.
So Nelson says of that 30 cents, 2.5 cents will be kept towards that contingency fund. And then 27.5 cents will be redistributed back to the policy owners, which are dividends.
And dividends in life insurance terms are a return of premium.
Yep.
Because the insurance company charged you for the worst case scenario, things turned out better than that, so they're returning you the excess that they charged you. So that's not a taxable event.
Mm-hmm.
Should we go ahead and give the listeners Nelson's airplane analogy to try and help describe why the actuaries and rate makers charge extra? They over-engineer the policy.
Yeah, let's give them an overview.
Okay, so Nelson is talking about the instrument panel in the airplane and how there's a red mark. Now he's saying if you run the airplane at the red mark for too long, that the airplane will come apart. Well, that's not true actually. You'd have to run it some 20 or 30% higher, faster than that for it to actually come apart. But they've just put a fudge factor in there to make sure that the plane doesn't come apart on you.
Mm-hmm.
And the same thing applies for the life insurance policy. That was the fudge factor that they put in there to make sure they can deliver on all their guarantees.
Yep.
And then Nelson goes into explaining how not only have they done that, but the way that the life insurance policy is built, it actually becomes more efficient with time. Do you want to give us a little rundown of that, Kyle?
Yeah, and an example that he gives is he bought a policy back in 1959, and at the time of writing this book, the dividend was over 10 times more than what the premium was.
Right. And so that's like taking off with a plane that's full of fuel. And say you have a 10,000 mile journey to make. Well, they had to fill the plane pretty full to make sure it had enough fuel to get to the destination, right, Kyle?
Mm-hmm.
And then after you've burned off 5,000 miles worth of fuel or 6 or 7 or 8,000 miles worth of fuel, the plane can still produce the same amount of power, but it's a lot lighter. So it's has the ability to do things that it couldn't do at takeoff. The life insurance policy does the same thing. There's less net amount at risk or insurance risk to the insurance company.
And the contract is guaranteed to reach the face amount at whatever, if it's a 121 policy, so it must grow to reach that amount. That's why it's...
Yeah, the cash value is just the net present discounted value of the death benefit minus the future premium payments. There is no such thing as buying a life insurance policy or a permanent life insurance policy without cash value. They go one and the same.
Yeah. So next, we'll kind of move on to the human life value. So you can't buy more insurance than what you're worth, so to say.
Yeah, and Nelson brings this up to show how most people purchase life insurance or look at purchasing life insurance. And I think he's also trying to make the point that this is absolutely not the way that we want to handle purchasing an IBC policy.
Mm-hmm.
So when looking at your human life value, an agent may come to you and say, well, just pretend you're 30 years old. So you have roughly 35 years to work in today's economy. And they say, hey, you make $40,000 a year. So whatever $40,000 times 35 is, they come up with that as your income that would be lost if you would pass away today. But they need to discount it because some of that money is going to be spent on you, your own personal expenses, and there's going to be an interest factor that we should put into that because the money should be growing if we get a lump sum today. And so they're going to discount that again, and they're going to look at that sum of money and say, if this comes out to, say, $500,000, how much would you pay to insure a machine that would produce that today?
Exactly.
Now, of course, everybody wants to insure it for $500,000, and So what happens next? We go and we look at how cheap of a term insurance policy that we can purchase.
Mm-hmm.
Well, Nelson makes it vividly clear then, right after that, hey, we just talked about everybody's need for finance is far greater than their need for death benefit, and we totally discounted that fact by doing just that operation that we did there and determining our human life value.
Yeah, and he also goes on to say that if you solve for finance while using dividend-paying whole life insurance, that you'll automatically have way more death benefit, and you will recapture all the interest.
Yeah, and it's something that, you don't hear anybody talk about that on the radio. If you tune into Dave Ramsey or Clark Howard, these guys don't ever talk about people's need for finance in their life.
Nope.
They just talk about buy the cheapest insurance you can get because they don't look at the whole banking function and how it's performed in your life.
Yeah, and so people they'll go out and buy the cheapest term policy that they possibly can. Then they'll go buy a car and finance that, when instead they could have just capitalized a whole life insurance policy, then borrowed from that policy to purchase the car. And by doing that, they would have really just cut out the middleman, because those car dealerships or whoever is financing the car, they more than likely are getting blocks of money from the insurance companies and then tacking on a surcharge to it.
Right. And who's paying that surcharge?
The car purchaser.
Exactly. But if you would have, so they got that block of money from the insurance company, they put a surcharge on it. So you were paying money to the insurance company directly for your term policy, and then you're paying money to the finance company, which was an indirect payment to the insurance company, really, because the finance company didn't have that money. The insurance company did. They just charged you extra for it for the convenience of working with them. So if you would have just initially committed to paying in the cost of your term insurance and your automobile into a whole life policy instead of a term policy, you've solved for your need for finance for that automobile at least. Not your entire life, but we're looking at one single purchase here.
Okay, so we'll move on to some final thoughts that we have here in this section. And Nelson, he goes on to say that corporations expected to take at least 7 years to get a profit on a new investment. So saying, he's relating this back to life insurance policy. You can't expect to break even on your policy in year one. We have expenses, insurance expenses to cover, and you can't buy something for nothing here.
Yeah, and he's also saying that, hey, this is just like starting a business, starting your IBC policy, and there's going to be some upfront need to capitalize it. Just like to start a business, say you have a excavation or dirt moving business, they had to invest a lot of capital to buy equipment to perform that.
Mm-hmm.
This is just another type of business. And it turns out that it takes a lot less time to build capital in a life insurance policy than it does in any other type of business. Plus, you have immediate liquidity.
Yep.
So what are some other thoughts that you have, Kyle?
He also goes on to say you need to build it to the point where you can accommodate others. And he relates that back to the grocery store. It's like if you own a grocery store, you aren't going to be the only customer at your store. So build this to where you can lend other people money or start other ventures with it.
Yeah, like what type of business do you have if you're the only person that you can service? Why not build it big enough to where you could finance other family members?
Mm-hmm.
Or you could potentially start your own business if you create a big enough pool of money and you've educated yourself on something that you're interested in and want to go into business doing. He's saying keep capitalizing your policy, because there's going to be the need for finance in the future, and you just can't see that right now.
Yeah, and he also goes on to say that your need for finance cannot be met with just one policy, that over time you're going to be using a system of policies to meet this.
Yeah, I think Nelson is saying you got to realize you cannot create a policy big enough to perform all the banking function in your life from day one. It's going to take some time to capitalize this policy. And once you've grown out of this policy, you can keep capitalizing it but you start another policy and another one. And until the point that you get to where you can finance everything in your life, there is always a need to keep adding policies to your life.
Yep. Well said.
So I think Nelson closes out on a good point here. And that is, so you've been practicing starting up these policies, you're performing the banking function in your life, and you need to take some time and try to teach your kids and grandkids even how this system works and why you're doing this. And if you're successful at doing that, this can become intergenerational and you could potentially never see the bank again.
Yeah. And this is one packed section with just lots of information. It should be reread multiple times. But I think we've pretty much covered everything in there unless you have anything else to add.
Nope, I'm good. So you want to get us out of here, Kyle?
Yeah. Thanks, everybody, for tuning into the podcast, and we'll see you next time.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.